And I think investors really need to pay attention because what he says and what he does will likely be the very same thing. We expect that tapering will lead to tightening, and that may be one, maybe two rate hikes next year. And that increases borrowing costs for both consumers and corporations alike, which ultimately put pressure on corporate earnings. So absolutely, we do think that the Fed has made a major stance change in monetary policy.
Yeah, so what does that mean for our investment portfolios? Okay, transitory's gone. We know that. Maybe we should never had it in the first place. Suddenly now we're more worried about a faster taper. I think that also played into some of the market move yesterday with options and everything else. What do we do? Do we change anything, Greg?
No, I think there's two really important takeaways, Brian. First of all, investors should be expecting more volatility. Over the last 3-4 years, Brian, we've seen the VIX largely under 35. We haven't had more than a 10% correction in a year. That's just not normal. Markets are typically choppier than that. But more importantly, investors need to reset their return expectations. We've been in an abnormally good stock market. Over the last 80 years, the S&P's averaged around 6.5%. 10 years ending yesterday's averaged 14%. So the Fed is going to cause more volatility. Inflation concerns are going to cause more volatility. I think investors need to reset expectations and raise the quality of their portfolio. In the equity side, we've seen that growth stocks have had this resurgence, tech stocks over the last few months, but we believe you want to make sure you have an equal weight to dividend stocks, cyclicals, financial companies, but also, Brian, the bond side. The Barclays aggregate bond index is negative year to date. So we expect investors are going to see as much, if not more, volatility in their bond portfolio than their equity portfolio. So laddering high quality individual bonds and complementing that with high yield or floating rate makes a lot of sense to us in this interest rate environment.
Any reason quickly, Greg, to own high yield bonds, not treasuries?
Absolutely, as a small sliver. High yield is called high yield because it's got some risk to it. So there is room as a small sliver. It's a nice diversifier as a small percentage of your fixed income allocation.